Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. This is On Trend, the show designed to keep you on the right side of the trend. Today is Thursday, May 23rd, and here's what we're going to cover today. We've got a Pennant in SPY that's taking over the oversold bounce, and I'll show you the difference between mean reversion trading signals and pattern signals. We got a big trend reversal working for oil, and that's going to weigh on energy. We'll look at the breadth on turnaround Tuesday as it fell short. We're going to cover banking ETFs and the defensive sectors. So I'm going to go ahead and grab this screen so you can see some good charts here. All right, so this first chart you're going to see here is SPY, and I was highlighting a mean reversion signal in SPY last week, and what we have is basically a failed mean reversion signal working, and signals are going to fail. That's just all part of trading. The question is, how many are going to fail, and hopefully you'll have more successful signals than failed signals. Now, to review a mean reversion signal, basically what you get here, and I'll go ahead and open this up to annotate, but I'm going to have to click something first. Let me go back on that. All right, if you just follow the cursor here, when you see down in the early part of March, RSI goes below 5 in that indicator window. And then RSI 5 goes below 30, and then it goes back above 30. And then you look back up at the prices and you get that mean reversion bounce. So you had that little pullback, and then you had the mean reversion bounce. And we got a bigger pullback in May, as you see there. But still, you know, after a 26% move, a pullback is expected. And we started getting signs of a bounce. So we got RSI in the indicator window moving back above 30. But that first little signal failed. And we got a second signal with RSI moving above 30. And if you look at prices, it was looking pretty good, but then we got a fallback. And then there's that gap up on Tuesday, which is that little white candlestick. And there was no real follow through after that gap. What you want to see on a gap is you want to see follow through with further buying after the gap to show continued interest. And instead, we've got a gap down today. So this mean reversion trade has basically failed because we've gone below that low from Friday. Now, the other signal was a move when the percentage of stocks above the 20-day EMA goes below 30%, then you're oversold. And then when it moves above 30%, you get in the mean reversion bounce. And mean reversion is based on the premise that you're in a long-term uptrend. And so when you get a pullback in that long-term uptrend, you're banking or you're betting on a bounce back to the trend mean because the trend mean is rising. And so that pullback is supposed to be an opportunity. Not all of them work out. So we move back above 30, and you can see we're already failing on the price chart. And you got to keep an eye on price because it really is the ultimate arbiter as far as the signals are concerned. You know, you may see a signal with an indicator, but if price is telling you something else, you need to listen to price before you listen to the indicator, I think. So what is trumping or overruling this signal here? Well, this next chart here shows a classic pennant. And a pennant is a short-term continuation pattern. So typically what happens, excuse the moving around there, is you get a very sharp decline. And this was pretty sharp. It was, 5 to 6%. And then you get kind of a consolidation. And that's what we had here. We had a bounce, a pullback, a bounce, and we're trading in this tight range. And now we've broken below the pennant support level. So it looks like we're signaling a continuation of this decline. Pennants typically measure the previous move and you add it on from somewhere in the pennant high area. So that would target maybe a move to around 275. And you can see the 200 days coming in right there around 277.39. But right now, this short term, this gap right here and pennant break are the dominant features. And you'd have to get above, say, this 50-day moving average at 287 to get the bulls back in good shape short term as far as the S&P 500 is concerned. This, of course, is SPY, which is the proxy for the S&P 500. And I don't really use the 50 and the 200-day for stocks and indices as support and resistance levels, but I have to admit it seems to work, or they seem to work pretty well for the S&P 500 because so many people watch the S&P 500 and those two specific moving averages. And so by extension, we have SPY. So the fact that we failed at the 50-day and we're turning down, a lot of people are going to see. As you'll note from last week in our Tuesday's on trend video, and even last week I was talking about it, the bearish 4-month period starts in June. So the combination of ripe for a corrective period, the bearish 4-month period beginning, and as I'll show you, that breadth indicator on Tuesday was not that impressive. Now, before we move on to this chart, I just want to show you percent B. And this is based on the level of the close relative to the Bollinger Band range in the indicator window. And if there's anything you need to know about an indicator, you can go to the Chart School for an article on that. Where is my stock charts? I will go back to here. There's the Chart School link, and I'll just open that in a new tab so you can see it. And if you scroll down, there you can see technical indicators and overlays. And if you click on that link, you're going to get all kinds of information, all the indicators covered here at Stock Charts. A lot of detail. We'll go into the formula, the method behind the madness of the indicator. And there is percent B. And there's two levels in particular that are important, among others, I think are pretty important for percent B. If you see at the top, when percent B is below 0, price is below the lower band. So that means you've had a pretty outsized move to the downside. Prices move below the lower Bollinger Band. So that is significant. And then you can see when percent B is above 1, price has moved above the upper band. So you've had a pretty significant move to the upside. So let's see what this looks like on the chart. So I need to just open this chart, and I'll go back because I need to put some Bollinger Bands. I didn't want to put the bands on right away and make for a cluttered chart. So I've got advanced options on, and I'm going to put these Bollinger Bands in area for the style, and I'm going to color them pink. And I want the opacity at 2, so they're kind of like shaded and shown just behind. And I'll remove the moving averages so we get a clean chart, and I'll click Update. And there we can see it. And I'll click Save, and then we'll go back to our other viewing option here. So this is a really cool way to view your Bollinger Bands, your Keltner channels, your price channels when you view them in this format of the area. And I did that on the other chart for some reason. But what we have here, sorry, there we go. Let me get this straight here. It keeps moving around on me. So what we have here is you can see price move below that lower Bollinger Band. This is a very finicky computer today. Stay. Okay. And it won't stay. So what we can see here is that price has moved below that lower Bollinger Band. All right. And if you look at percent B there, you can see in the lower right-hand corner that it has moved below 0.25. Now, I looked at some different settings, and yeah, 0 is when it moves below the lower band. But if you're looking for an earlier signal, you'll have to raise up that level. So if it moves below 0.25, as it did there in early May, that shows an outsized move. At least the biggest move we've had since December, basically, on the downside. And then if you look back to January at percent B, you can see it made that move above 0.75. And even in early February, it just touched the 1 area. And then in March as well, it got above 1. And if you look at the price chart, you can see that we got above the upper band there, and we were hugging the band. That's what John Bollinger calls walking up the band. And it's in his book, Bollinger on Bollinger Bands. And the concern here now is that you've come down pretty hard below the lower band and you've broken the pennant with a gap down. And the concern here is that you're going to walk that band to the downside. Now, is this a bear market? Well, I'm not going to call it a bear market. I'll have to look and see how the bigger breadth indicators that I track did this week. And I'm not going to move to a bear market stance until they change. And that will be updated on Friday in the weekly market review and outlook. I still view this as a correction, but it is yet to run its course. And what would I look for to suggest this correction has run its course? Well, I would look to breadth. And this chart here shows AD percent. And that is advances minus declines divided by total issues. And if you look over there on the left, you can see I've given a formula there. And you can see using the S&P 500 as an example, if you have 450 advancing stocks in the S&P 500, that's 90% of all issues going up. All right. And then if you have 50 declining stocks, that's 10% of all issues going down. So 90% minus 10% equals 80%. So ADP, advanced decline percent, gets to plus 80%. That shows exceptionally strong buying pressure. The flip side would be a minus 80% down day, which shows exceptionally strong selling pressure. So if we look in early or late December and early January, we had two 80% up days. Well, I put triple, but we had one in late December, one in early January. And the reason I call them triple is because we got them in the S&P 500, the S&P Mid Cap 400, and the S&P Small Cap 600. And now if we fast forward to May, you can see we got those two 80% down days in all three as well in early May, twice. And we have yet to get above plus 80%. So there's Tuesday's big move, and it fell just short of 80% for the S&P 500 and the S&P Mid Cap 400, and well short for the S&P Small Cap 600. So as far as I'm concerned, I would like to see some sort of a breadth thrust to suggest that the buyers have come back with confidence, and that would suggest that maybe we're ending this corrective period that we're in right now. All right, so we're going to move on. I want to look at oil next because oil is looking rather vulnerable to the continuation of a big downtrend. XLE is gapping down. XES is hitting new lows. I'll just show you USO as a peak. So you can see USO gap down and fell very sharply. Oil's down around 5% today. But if we look at the longer term picture for oil, it is bearish. All right, so what I've got on this chart here is you can see that massive decline, October, November, December. And then we had a huge advance, but we still fell well short of that October high, and we retraced around 2/3. So Charles Dow said anywhere from 1/3 to 2/3. Fibonacci people would say anywhere from 38% to 61.8%. So you can see it's a rough estimate, all right? But you can see it was around 2/3. And so after that retracement, we had that breakdown, and I've got Bollinger Bands on, and I've got percent B below there. And Bollinger Bands are also used as a trend following indicator, because when you get a surge above the upper band, or in this case, as I've marked the levels at 0.75 or a surge below 0.325, that can signal the start of an extended move. Now, you got to keep in mind that the concept of trend following means you're going to have lots of whipsaws. And the concept behind the success of trend following is that one good trend is going to pay for those whipsaws. So if you use this indicator on other charts, you're going to see a lot of whipsaws, and you might need to adjust it All right, you might need 0.90 and 0.10 for your signals. You don't want to curve fit it, but what I'm saying here is it's not going to look as good as it does on this chart until you catch a good trend. So if you see here, you had 1, 2, 3, 4 whipsaws. If you had been, selling for a downtrend in May with a break below 0.25, buying with an uptrend on the breakout in June, and then selling and then buying, and you would have been frustrated by the time September, October rolled around, and you would have gotten a signal in mid-October, and you say, the last 4 didn't work, I'm not going to take it. Well, trend followers don't know which signal is going to work, which one's going to fail. But as you can see, this one was a dandy because you had that huge decline. And then we got another signal in early January when %B moved above 0.75, and we had a big rally in oil. And now we've got another signal in %B moving below 0.25 twice now. And probably with today's weakness, it'll be further below. And oil will be below the falling 200-day moving average. So a lower high, a reversal near the 2/3 retracement, falling 200-day, below the falling 200-day, and %B plunging below 0.25 with an outsized move to the downside. Oil is bearish. So I use West Texas Intermediate for the long term, and I'll look at USO for the short term. And you can see here that USO, I need to go fix up that chart. But what we had here was a decline, and that was the decline that broke the back of West Texas Intermediate up there. And so when you have a bearish longer term signal on the chart, short term, you turn to look for bearish setups. And a bearish setup would be kind of a rising flag. And you can see you have that little gap up, that little gap down, and now we've got a breakdown. So I would suggest that oil is probably going to test those lows from December. And then if we go back and we look at XLE, the energy SPDR, we can see that it is below the falling 200-day moving average. In fact, it failed at the falling 200-day moving average. Okay. Just afraid to touch this mouse because it's being very sensitive today. So there we had the big decline. And then you got the big advance from late December up until April. You hit the falling 200-day. Yeah, that's not necessarily resistance, but it worked that time. And you retraced around 61.8%. And then that was the decline that broke the bulls back. All right, you had a decline off the falling 200-day. %B moved below 0.25. Then you had this little wedge, and you broke the wedge. And now we're continuing down for energy. And then oil and gas equipment services looks even worse. It had this breakdown earlier, and it was below the March low first. So it is looking like it is headed to a 52-week low. All right, so next I want to look in on the banks because the banks are not looking very good. The finance sector is doing okay because you've got a lot of strength in the insurance group. All right, KIE is hitting new highs. It's down today, but it hit a new high yesterday, as you can see there. But if you look at the chart for the bank SPDR, KBE, you can see that it is below its falling 200-day moving average. All right, you had a failure at the 200-day there, a sharp decline. You got back above the 200-day, but now we've fallen back below. And even though we moved above the 200-day, you have to notice where this one is. That's KRE. Let me go back to KBE. You have to remember where it is relative to the S&P 500. So the S&P 500 was hitting new highs here in April. And KBE was not even close to its prior highs. It was below the February high, or it met resistance at the February high, and it broke down. and it's back below its falling 200-day moving average. So it is seriously lagging as far as the market is concerned. So wouldn't be interested in banks. And if you look at KRE, which is regional banks, there are a lot of regional banks in the small cap ETFs like IWM and IJR, and it's even weaker. There you can see that February high. We didn't even challenge it. Failed at the falling 200-day. Sharp decline. This looks like a little pennant, and then we broke down. So banks are not looking very healthy at all either. So where is strength in the market? Well, I think you can guess. It's in the defensive group. But before we get to that, I just want to show you a table that I look at on a regular basis. And this is to define which sectors have internal strength and internal weakness, short-term and long-term. So this indicator group is the percentage of stocks above the 20-day EMA. And for this table, I've got it for the S&P 500 plus the 11 sector SPDRs. And I just created a chart list, and there you can see the symbols. They're very easy to create, and that's also handy. You just hover over the symbol and you get a chart to view. So it's exclamation point GT20 and then the SPDR symbol, XLC, XLY, XLP, and so on. And so you put these in a chart list, and then you can view them a number of different ways. And I've got summary format. So once you have summary format, you can sort. And you can click the column heading to sort. And I would like to sort by the close. So I've got a top-down sort, and I've got the strongest short-term indicator setting values at the top. So 85% of stocks in the utilities SPDR are above their 20-day EMA. Utilities are by far the strongest sector, and they also are the strongest sector long-term, as I'll see with this percentage above the 200-day EMA. REITs next, staples next, and healthcare has perked up short-term with 63% of stocks above the 20-day EMA. Finance is not doing too bad with help from insurance. And then there's our benchmark, the S&P 500 at 48%. Now here's where we get into weakness short-term. You can see technology is weak short-term, industrials, consumer discretionary, energy, and materials, the weakest. So now what I want to do is see what the long-term looks like. So I'll look at the percent above 200-day EMA long-term. And when I change to that chart list, I keep my sort. And we can see utilities, real estate, and staples, the same three at the top. So long-term and short-term, these three sectors have the strongest internal strength as far as percentage of stocks that are above the 200-day EMA. Technology is still holding up, but that may change today. There's your benchmark, the S&P 500, and everything below the benchmark is underperforming. And at the bottom, we can see energy. 28% of stocks are above the 200-day, by far the weakest sector, and it has been the weakest sector for a few weeks. Materials also very weak. And look at small caps. Less than 40% of stocks are above the 200-day. Put another way, more than 60% are below the 200-day. So that's where we're seeing weakness. So if we look at some individual charts here, I'll switch to a chart list, and I think it was number 2. This is the Monty Hall game, door number 2, door number 3, or door number 5. No, it's not. It's in the there we go. So here's consumer staples, XLP. And look at that. It hit a 52-week high 5 days ago. It has just been going straight up. And if you look at the lower window there, the red dotted line shows the S&P 500. And you can see it's starting to move lower. And XLP is holding its strength there. So it's continuing to move higher. That's relative chart strength. and you had what looked like a little flag there, and it broke out of that flag and is the strongest or one of the strongest sectors right now. Then we look at REITs, very strong REITs. So we had what looked like a little triangle consolidation. You had this big move up first, and you became overbought, but you're breaking out to 52-week highs, and you're holding above the breakout zone, and you're consolidating, you're digesting those gains, and now we're breaking out again. So REITs remain very strong. The hunt for yield is on. And there's the S&P 500 SPDR edging lower and REITs continuing to hold up. And then we look at utilities. All right, they're the strongest because they're at a 52-week high today. So they had this big move up to a new high, a flag-like consolidation pullback, and a breakout there to new highs. And there you can see SPY moving lower and XLU moving higher. So the appetite for defensive issues is very strong. And I'm wondering if healthcare is going to start partaking in this move towards defensive groups. Now I just want to highlight 4 stocks that are breaking down that I think are fairly important as far as the breakdowns are concerned. This is General Motors, and it's part of the consumer discretionary sector. And we've seen the breakdown in retail, XRT. We've seen the breakdown in some retail stocks like L Brands and Kohl's and Nordstrom. Nordstrom broke down. And if you look at General Motors, look at that big decline, May, June, July, into October. We had a nice advance, but look at that. There are those highs from February, and we didn't get above those highs in April. So the S&P 500 is making new highs in April. General Motors is not. And you can see the break below the 200-day, the break below the March low, a support break. So it looks like General Motors is heading for a test of those previous lows. Then we look at Goldman Sachs. If Goldman Sachs can't make it, which banks or finance companies can? And Goldman Sachs has been below its 200-day for some time. Yeah, it got above for a couple days, but it was never outperforming. All right, it's never near a 52-week high. And basically, it's failing at this falling 200-day, had the sharp decline, a little consolidation, and now it is breaking down. And then finally, we are JB Hunt as well. UPS and FedEx have broken down. So this is another bearish sign, and American Airlines has broken down as well. American Airlines has a descending triangle working, and that was my first chart here. You can see the lower highs and the relatively equal lows, and that is what has caused them. So that is it for today's On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.